Yields and spreads. Understanding financial concepts for trading and investing. Presentation overview. Basics of yields. This section will cover the basics of yields and how they are calculated. It would help understand the return on an investment and the risks associated with it. Types of spreads. This section will explore the different types of spreads and their uses. It will help understand the relationship between bond yields and their spreads. Trading strategies. This section will look at how yields and spreads can be used in trading strategies. It will help understand how to use them to identify investment opportunities and manage risks. Understanding yields. Yields are a measure of the return on investment for bonds and other fixed income securities. It represents the percentage of the amount invested that is returned to the investor over a specific period of time. What are yields? Current yield. Current yield is the annual income generated by a bond or fixed income security, expressed as a percentage of the bond's current market price. Yield to maturity. Yield to maturity is the total return anticipated on a bond or fixed income security if it is held until it matures. Yield to call. Yield to call is the yield generated by a bond or fixed income security if it is called by the issuer before it matures. Factors affecting yields. Interest rates. Interest rates are one of the most important factors that affect yields. Higher interest rates generally lead to higher yields, while lower interest rates lead to lower yields. Credit risk. Credit risk refers to the risk default on a bond or other fixed income security. Higher credit risk generally leads to higher yields, while lower credit risk leads to lower yields. Inflation. Inflation is another important factor that affects yields. Higher inflation generally leads to higher yields, while lower inflation leads to lower yields. Types of yields. Current yield. Current yield is used to evaluate the income generated by a bond in the current market. It is calculated by dividing the annual interest payment by the current market price of the bond. Yield to maturity. Yield to maturity is used to evaluate the total return on a bond over its term. It takes into account the current market price of the bond, the face value, and the time remaining until maturity. Types of spreads. Bid-ask spread. Bid-ask spread is the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller is willing to accept. Option-adjusted spread. Option-adjusted spread is the difference between the yield of a security and the risk-free rate of return, adjusted for the embedded options. Z-spread. Z-spread is the constant spread that must be added to each spot rate on the Treasury curve to make the present value of a security's cash flows equal to its market price. Bid-ask spread. What is bid-ask spread? Bid-ask spread is the difference between the highest price a buyer is willing to pay for a security, the bid, and the lowest price a seller is willing to accept, the ask. Uses of bid-ask spread in trading. The bid-ask spread is a key metric that traders use to gauge market liquidity and to make better trading decisions. Higher bid-ask spreads are usually associated with lower liquidity and higher transaction costs. Option-adjusted spread. Option-adjusted spread is a type of spread that takes into account the possible changes in interest rates and prepayment risk in a mortgage-backed security. Calculation of OAS. OAS is calculated by adjusting the spread of a mortgage-backed security for the value of the embedded options, such as prepayment options or call options. Use of OAS. OAS is used in evaluating the relative value of mortgage-backed securities and in making investment decisions in the secondary market. Z-spread. Definition of Z-spread. Z-spread measures the difference between the yield of a security and the yield of the benchmark Treasury securities. It is the type of spread that is used in evaluating the value of a bond. Z-spread calculation. Z-spread is calculated by adding the spread to each cash flow of the bond to make the present value of the cash flows equal to the market price of the bond. Comparing bonds with different maturities. Z-spread can be used to compare bonds with different maturities. It provides a way to compare the yield of a longer-term bond to a shorter-term bond with the same credit quality. Using yields and spreads. Yield curve strategies. Yield curve strategies involve analyzing the relationship between bond yields and maturities to predict future changes in interest rates and economic conditions. These strategies can help investors generate higher returns while minimizing risk. Credit spread strategies. Credit spread strategies involve analyzing the difference in yield between two bonds with different credit ratings. These strategies can help investors generate higher returns by taking advantage of differences in credit quality. Yield curve strategies. Yield curve strategies involve taking positions based on the shape of the yield curve with the aim of profiting from changes in interest rates. Credit spread strategies. Credit spread strategies involve taking positions based on the difference in yield between two bonds with different credit ratings. These strategies can be used to generate income or hedge against risk. Factors affecting credit spreads. There are several factors that can affect credit spreads, including changes in interest rates, credit ratings, and market expectations. Conclusion. Yields and spreads are critical concepts in finance that help investors and traders make informed decisions and build effective trading strategies. Thank you.